guys. My name is Abdel, mortgage lender locally in the state of New Jersey with Got Mortgages. Really been doing this for quite some time now, kind of seeing pre-COVID, post-COVID, kind of that funky phase of what we're going through right now, simultaneously, of what I like to say. Some of the different strategies I think we're going to start talking about, Carlie, right, of what are the things that we've been implementing with our clients. Mainly from an education perspective, I think that's what a lot of clients are really looking for now more than anything, right? Interest rates come and go. Home prices go up, home prices go down. It comes down to a supply and demand at the end of the day. But also understanding with a lot of clients, there's no one size fits all mortgage. I say it all the time. Every single person's situation is unique. I literally have a situation right now where the clients are really monthly payment conscious. We did an appraisal. They wanted to cancel prior to the appraisal report because they were just going back and forth and the payment was a little too high. The appraisal report came in at $483. The purchase price right now is $470. So what I ended up doing was structuring a seller buy down and doing a $13,000 seller's concession, 2-1 buy down. Client's monthly payment went from $4,200 to $3,600. So they're actually saving for the first year about $600, and the remaining money from the seller's concession of $2,500 gets deducted from their closing costs. So I think it's more of thinking of creative avenues at the same time is really just some of the things that we usually do on our end without throwing in that towel, right? Quickly, like some other professionals do, or just stop picking up the phone, when they know that things are getting a little tight or tough. And that's some of the things that we do. So.
Right. And that's some of the experiences that most realtors can attest to, is that they start working with a lender. They're phenomenal. They're super communicative. They're pre-qualifying your client. They're guiding them through the process. And then all of a sudden we hit a speed bump and the loan officer is MIA. He's not responding. He's not giving us an explanation. When we have the facts, we can try to work on a resolution with the buyer. Maybe he could get a gift if he's short on the down payment money or the closing costs, or we can actually buy down the rate and try to renegotiate with the seller to contribute towards that. So there's so many different things that is imperative for us to have good communication with the loan officers, for the client and the realtors, because the realtor is kind of like the person the glue that keeps everybody together.
Totally.
The realtor is supposed to be the one that moves all the parts around, communicates with the attorney, relays information back to the buyer and seller. Same thing with the loan officer. So we are kind of the liaison, and sometimes we have to be the problem solvers, because in real estate, especially with the crazy market that we're in right now, that it's constantly fluctuating, kind of like similar to the stock market, we need to be able to inform our clients of everything from A to Z. So like that, it's not as stressful, because the market is stressful enough. It's stressful enough to get an accepted offer. It's stressful enough to constantly be rejected and having to up your offer or finesse it a little bit in order to get it accepted to the top of the list. And that kind of leads me into, I guess, the diversion of having you be the person to educate them, but also to educate them on financial wealth. For instance, like Abdel and I have gone on calls with some of my investors, and we will look at their situation and see what is the best plan of action, so that client can maximize on their investment. So that client can not only make money with this property, but also hopefully make a lot more money with future purchases and other properties or other investments. So we're kind of like the people that work together to establish the best financial outcome for you and your family.
Yeah, I agree. I mean, I think it's what I keep going back to it, right? There's no one size fits all.
Right.
So the first thing I always sit down, if it's a home buyer, I always break it down to its two main things: your monthly payment and your cash to close, right? In terms of a qualification perspective for a consumer, because that person, more or less, his main concern is how much am I going to pay per month, putting aside qualifications, putting aside all that stuff. It's how much am I paying per month, and is that a comfortable budget that I have in the back of my conscience? And then how much do I bring to the closing table, right? Those are two, what I say, of the biggest drivers between a client keeping a deal or a client want to canceling a deal, right? And then from an investor's perspective, right, it's kind of the same, but I also throw in the third, which is the ROI, or is there a cash flow on the property itself, right? Is it cash flowing itself? Most of the time, especially with investment properties, usually has to, depending on the specific type of loan. Like if you're going with the DSCR loan, right, the rentals more or less have to cover the mortgage payment, which alleviates the risk of you having to get a full doc loan anyway, right? So I think it's just identifying, most importantly, what is that client looking for, whether it's an investor, first-time home buyer, or a consumer who's just trying to get interested. Down payment assistance now is starting to pick up a lot of traction,
right,
in terms of the upping of New Jersey, in some counties going 15K with the NJHFMA. And I think it's just getting a client to understand. I'll be that call. Actually, how you and I first connected, right, was it wasn't even on a regular transaction. It's, hey, dude, I have a client, X, Y, and Z lenders not really communicating. Can you take a look at it? And I think we literally made more progress in digging out what was the root of the issue than you know, prior person. So I think it's just just cut the crap, get to the issue. What's the problem at hand? Set the communication, set the expectation. And you know me, I mean, we're closing. I just closed a cash out refi 4 business days. Just closed a VA loan 10 days when the other lender had it for 3 months. And I think it's just unraveling what's the issue, what's the concern, what is the consumer looking for, and then communicating with us, right? Communicating with the other side. This is where we're at. This is where we're setting the expectation, and having just a firm understanding of what's the market going through, and then we take it from there.
Right. And honestly, to attest to his quickness, we have actually closed deals, and that is such an imperative point to make, because we're still in a very competitive market. We're seeing multiple bids. We're still seeing over asking price sales. And when we're working, especially with our FHA buyers, and they are competing up against 20% down, cash buyers, things of that nature, you're never going to get your offer accepted or your client's offer accepted with just a 3.5% down in regular terms these days. Like, they're going to be pushed to the bottom of the list, or they're going to be in a completely separate pile where they're not even going to look at it because they got like 5 other offers that are much superior as far as terms are concerned.
Correct.
So if you're going to submit an offer for a VA, an FHA, or less than 20%, or you know that there's more cash buyers coming to the table, because I've had several properties where it's a rehab. So guess what we're going up against? Contractors. What are they coming in with? All cash. So we may be bidding up against 5, 6, 10 contractors, all cash. What's going to make you stand out from everybody else so you can get that home and maybe do a 203K rehab loan and fix it yourself and get that deal? You're going to want to work with a lender that is going to close you really quick. Like, he could get you a mortgage commitment in 48 hours. Then he could close you in like 2 weeks, 1 week. That's going to move you to the top of the pile now, because people that are selling usually want to get their cash quick. They don't want to wait 45 days. They don't want to wait 30 days, especially when everybody's offering them better terms. So what's going to make you stand out is working with a lender that can process your loan quickly, have that communication with you, answer your questions, educate you along the way, so it's not as nerve-wracking, and it kind of like makes you feel comfortable with the whole process to hopefully do it again, to continue building your real estate, your wealth through real estate.
Yeah, and you hit it right on the money. I mean, it comes down to, you know, I always take a look at it when you're putting an offer together. It's the 5 things, right? Starting off with your terms. What's your loan type? Which in many instances, you know, sometimes you can't control. If your credit's a little on the lighter side, you got to go FHA.
Right.
That's okay. Now, understanding from there, from the inspection standpoint, is we're going to connect and we're going to go and be like, hey, what do you think? Should we waive the inspection? How's the property condition? Things along that nature. Should we limit it to mechanical, structural, environmental? Then talking about the appraisal. Car, what do you think about the appraisal? How's the comps? How's the stuff in the area? If it does under appraise, like you have seen, I always say, right, there's 5 different avenues of what we could do. Dispute the report. We could bury the shortage in the LTV. We could go back to the seller and negotiate. We could simultaneously sit there and see if we can just, unfortunately, cancel the contract, or I always say the fifth thing is taking a look at the loan to value as to what you can add and what you can reduce. But you bring up a good point, and carrying on is your closing timeline, right? Some offers you're fighting against is cash. Now, if you confidently can go in there and say, I'll give you a mortgage commitment before we're out of attorney review, like I usually say, and put it in the contract. I'm confident in my team. It's not me, it's my team. My team behind me with Pam, with my underwriters, with my regional corporate underwriters, they're allowing us the confidence and the opportunity because I'm preparing the file in advance correctly, right?
Right.
And we're also asking those, did you have the bankruptcy? Did you have the foreclosure? Did you have the short sales? You know, the last refi that I just did, that just got clear to close in 4 days, client has over 80% equity in the home. No, I'm sorry, 20% equity, 80% loan to value in the home, but her score is light. It's a 608. So she's like, oh, let me wait for my credit to go up. I'm like, well, why would you do that? I'm like, let's do it this way. Pull out your cash right now, because the market, you never know if it's going to shift. Pull out your cash, pull it out. You're paying a $35,000 car note that's probably at 20% interest rate, if not higher, because they had a pretty subpar bank. Pay that, and then simultaneously pull out the rest of the equity. And we did exactly that and paid off some back taxes. So I think it's just assessing and getting that to understanding to the client, because when you do that total cost analysis of you're going to refi again, it's not that expensive. It's about $3,000 to $4,000 with just the title fees. And then when you're fighting against those cash offers, right, you close quicker. That cash investor, but at the same time though, most of the times, and you can attest to it, right, a lot of the people who claim that they have cash really don't. Or
Right.
sometimes it's tied into certain things. Or if they do have it and you ask for a POF, for a proof of funds, they're a little bit more meticulous to, well, I want this, and if you're not going to give it to me, I'm out, right?
Right.
As opposed to sometimes with the financing, you know, depending on the logistics of the terms, a buyer and seller is a little bit more understanding, a lot different than it was back then. I think now it's really not a buyer's market or a seller's market. I think really both of them are kind of in the front seat, and then they're both, if I could give an analogy, kind of asking each other for directions, right? As opposed to, you know, as opposed to before, it was like, well, screw you, take it or leave it. So yeah.
Yeah, we're experiencing a lot of that, and it almost seems like, you know, we're watching the rates because it has such an impact. I mean, this is now the generation of information. Everybody's on Instagram and Facebook and LinkedIn and whatever, and they're reading online all these different fluctuating reports that are out there. The rates obviously have a huge bearing on the market. And I think initially when the rates rose, everybody got a little paranoid because they were so used to the 2% and 3%. So everybody jumped out of the pool. And then the rates came and dipped and everybody jumped back into the pool. So it's like the stock market. It's like one couple weeks it's like a buyer's market, the next couple weeks it's like a seller's market. But I feel that now we're starting to feel everybody getting stabilized and more comfortable. Like even the buyers that jumped out of the pool because the rates had spiked up, I feel like now they're becoming more like acquainted with the rates at like 6%, 5%, whatever the case is, and they're coming back out, and we don't have enough inventory. So we have to use every advantage that we can get as our arsenal to submit offers to get your offer accepted and hopefully get you your new home or investment.
Yeah.
But I did want to like go back to the grant program that you had mentioned, because you and I have spoken about it. We've tried to get a couple of people into it. I want you to kind of give a little bit more information on that, because I always get questioned dozens of times. Can I do it in Mountainside, New Jersey? And I'm like, I don't know. That's a little bit more of an affluent area. I don't think they're offering it there. But give us a breakdown and the facts of what goes with the grant. How do you qualify? What's the process like?
Yeah. So the first step that you have to do is work on getting pre-approved with a lender. So because how it works is that you have to go to an approved NJH FMA, which is the Smart Down Payment Assistance Program specifically. You have to go to them. They gather all your paperwork and the necessary information, such as your pay stubs, your tax returns, your credit report, things on that nature. Gather it up, and then we send it to the state. The state thereafter confirms for us based on eligibility. Now, the eligibility does vary per county, and you had mentioned it, right? Depending on, and I'm not sure what their algorithm for some of the, if it's affluency or demographics or whatever it is, but there are some counties in New Jersey that are 15,000, and there are some counties in New Jersey that are 10,000.
Right.
So we'll do the assessment based on what the client's looking for and set the expectation as to what they're to expect. And it's usually based off of your credit score. I believe it's a 640 off the top of my head, 640 credit score. There's also income restrictions too. And this is usually why I tell some consumers, like if you're making well over 6 figures, you're likely not going to qualify for the down payment assistance. But again, for me, we submit the application and then we hear back, right? But those are usually the two main driving forces, are the income restrictions and the credit restrictions. And then thereafter, when we submit it, the state, I'm sure, has their own individualized, internalized checklist of what they look for. They do take time, though, so a lot of the times when you're submitting them, you're not getting a 1, 2, 3, like as if I'm getting a desktop underwriting approval.
Right.
You're waiting on the state. We know a few consumers are there. So if you are interested in doing it, it's very important for somebody who should attempt to work with a approved NJH FMA lender to get their process kick-started thereafter.
And so that grant could be used towards their down payment and closing costs or.
Correct. Yeah. You can use it towards your down payment. Whatever is remaining can be used towards your closing costs. And that's not the only one, right? I've done a few with, it's called Chenoa.
I've heard of that one too.
That's specifically with FHA. Very, very similar parameters as well. That, if I am not mistaken, is only towards your down payment. Could be wrong. But same parameters, right? Usually the two main driving forces is your income restrictions, alongside with the, what's it called? Income restrictions alongside with the credit score.
Right. So are you getting more offers presented with seller's concessions since we've had the shift?
So this is what I always say when we're talking about presenting an offer, right? The main driving forces is, aside from the terms and all this stuff, but talking about the property itself, is how long has the house been sitting on the market? Because you and I both know that Elizabeth, Union, Middlesex County, Essex County, it's still hyper competitive.
Super.
So, and if you're going for a multi, you're not getting
not happening.
Unless the house is like beat up and you got to go 203K, which is perfectly fine. I love doing 203Ks. I'm very familiar with them. But definitely a lesser of a request since February, where rates kind of shifted after unemployment and employment numbers came out, which I think is going to change. Like you and I spoke, right? March 10th and March 14th. Upcoming this month, I think is going to be very, very good for us in terms of unemployment readings and inflation readings. We'll get the February data, but maybe we'll see a shift thereafter. But it's always going to be a supply and demand, and we're shifting now into the spring summer market. And in order for you sometimes to get a seller's concession when it's hyper competitive within that time, it's usually diminished. So tapping into your 401k, tapping into the mom and dad fund, right, for gifts and stuff like that, is definitely sometimes more plausible than going the seller's concession route.
Right. And so, for my buyers out there, I don't know if you guys know, but in the industry between like loan officers and realtors, I hate to break it to you guys, but we refer to buyers as liars, because lots of times they're just shy or embarrassed that they don't have enough, or their credit is not as good. No one feels good about saying, hey, my credit's only 620. So they lie to us and they're like, yeah, my credit's like almost 700. And then we go check, it's like 610, whatever. But the thing is that as long as you're honest with us, we are part of your team. We're here to assist you to achieve the goal, which whatever that may be, it's purchasing or investing. So you need to be honest with us. Like, we're not going to judge you. We definitely, by fiduciary like oath, we cannot disclose your financials. So we're not going to tell, oh my God, this guy filed for bankruptcy 2 years ago. Everything is confidential between Abdel and I and the attorney. So you can be honest with us, because that will then give us the cards to assist you and hopefully get you, you know, to increase your credit score by some simple little fixes like removing inquiries or whatever the case may be. So then we can bring up your credit score so that now we can obtain a better interest rate for you or find a better program for you. So buyers, please, please, please be as honest as you can with your realtor and your loan officer, because it's going to save a lot of drama, and it may end up saving you a lot of money in the long run. Because if we know ahead of time, we can start implementing certain things to help you. So then when you are ready, or when you do find that home, you're ready to lock and load at the best possible program and rate out there. So that's a very critical thing that you guys need to keep in mind. And then I know that Abdel mentioned a 203K loan. And for the people that don't know what a 203K loan is, a 203K loan, you can do a standard or you could do an FHA. And if I say anything incorrectly, just correct me.
Standard and limited, yeah.
Yeah, standard and limited. So the standard, if I remember, it's unlimited. It's for like down to the structure, plumbing, electrical, roof, anything and everything that needs to be rehabbed because it's not even in livable condition. Whereas the limited is if you want to just like upgrade the kitchen and make it more modern, it's more cosmetic, it's usually lesser loan amounts, but it does not include like incorporating an in-ground pool in your backyard or an outdoor summer kitchen. It is technically like just for improving what you originally have already.
Yeah, so it's
so do you want to go and elaborate that?
Yeah, so price point. So anytime you spend I believe it's $35,000 if I'm not mistaken, which includes a contingency reserve. So anytime you spend less than essentially, let's say 30 grand, 35,000, you go the limited route. Anytime you spend more than that, there's another, I always say with 203Ks, there's additional hands in the cookie jar, right? So when we're doing a deal, right, it's obviously the realtor, you have the lender, but then you simultaneously also have a third party appraiser, a third party inspector, and then in New Jersey, you don't have to, but I always recommend you get an attorney and a title company. Now, when you're going for a 203K, there is a third party, two more third party people that are involved, which you have a HUD consultant, and then you also have the contractor. And those two are probably one of the most important people when you're doing a 203K. Because the how it works and the right way to do it, in my opinion, is that you see the property, you like the property, you make the offer. When you have the contractor go with the HUD consultant, right, and they get on the same page from the beginning, because when they do that, literally they put the deal together, and then it's this matches, you're going to spend 10 grand in the kitchen, you're going to spend 10 grand in the kitchen. You're using these cabinets, you're putting this, you're putting that, right? Because that has to match, and then you do the appraisal, right? The importance, I say it that way, you know, a lot of people will go in there and they're like, well, I'm going to spend $150,000. And I'm like, well, that's a lot of money, you know? I'm like, well, let's take a look at it. Let's get the consultant in there. Let's do it. And then it's sliced to like 70, you know? And I'm like, that sounds a little bit more realistic in terms, unless you're doing like a full blown gut. And I usually tell the clients, right, you can also bury in the contingency reserves. If the house is not livable, you can sometimes bury some monthly payments into there, right? Because you're not actually living it, your monthly payments still due. You can bury some of those contingency reserves within that as well in an effort to offset whatever you don't know. So
so basically the 203K allows you to do your down payment, whether you're putting down the 3.5%, the 5, 10, 20, whatever, pay your closing costs, but then you're going to be mortgaging the balance of the purchase of the home. In addition to that, you're going to be getting the money to rehab the loan. So to pay the contractor to do the kitchens and the rehab, well, entirely. So that's what a 203K is. So there's one that you can do regular conventional, and then there's another one that you could do FHA. So there's options out there.
Exactly.
So now, as far as like the market, let's talk about these rates. Now, I want to hear your opinion, because I don't think I've ever asked you, even throughout all the times that we talk throughout the day. What do you feel about the people that say, buy the house, marry the house, and date the rate? Like, I want to hear your true, raw opinion on this.
So I despise the saying, which I've said numerous times. but it's true. Like the ideology behind it is true. So I tell a client, so, you got to think about it. I always relate it to when I bought my house. So when I bought my house down the shore, I bought it in the height of the market, 2021, June. The house was listed for 600. I offered 660, waived the appraisal, waived the inspection, 10-day closing, mortgage commitment in 48 hours. And I still barely just got the offer because someone came in 695, which is
oh wow,
right. And I knew because we were talking to the listing agent, yada yada. I told him we work in the industry. Eventually, the offer got accepted. So $60,000 over. Thank God the house appraised for 665. So I was in the clear. But same aspects now, right? You could potentially get the house for maybe 615, right? 620. It's still competitive. So you're still going to go a little bit higher. You're saving about upfront, let's say $40,000 to $50,000 a month. My interest rate is a 2.75, which is obviously the hardest pill to swallow when I'm offering you right now 6 or 6.5. But again, you get the asset for 600 or 620. I got the asset for 660. Now,
right.
Eventually with this one, you're going to pay based off of the 6.5 interest rate. But as the market starts to dip, which it's always going to go up, it's going to go down, it's going to go up, it's going to go down. You need to be working with a trusted professional on the lending side and the real estate side to find out your comps, right? And then time it correctly, and then understand that a refi can be done, like I just said, in 4 days. I just did mine, and you're good, right? So it all comes down to, do you want to, as the market really shifts and interest rates drop, if you have the ability to qualify. I always tell my client, if you can qualify at the slightly higher rate, you have the money, you have a secure job, you have already beat so many people who are sitting on the sidelines, not by choice. They're sitting on the sideline because they can't qualify, right? Because the rate did that shift. They only could qualify at 3-4%. Now that the rate shifted, their monthly payments went up, they no longer can qualify. You're going to have a more competitive advantage to get your offer accepted without having to go bananas in terms of high offerings, and get the offer accepted. If you pay a slightly higher rate right now, you can do what I just did. If you really wanted to, you have the aspects of a 2-1 buy down, where your first year, your monthly payment, if it's 6.5, your first year is 4.5, and then you're paying that much less, and then you attempt to refi it after the year. And if you can't refi it after the year, the second year, you're still paying at a 5.5% interest rate, right? In terms of the escrows. So there's that in terms of that. In terms of interest rates and market shifts, right? At the end of January, interest rates were the lowest that they were in 4 months. And then all of a sudden, they shifted because of, like I had mentioned, that what I call misleading jobs report that came out, where they said 817,000 jobs were created, which were all part-time jobs. Yeah, they were all misleading part-time jobs, or they were old jobs that they didn't attribute to the prior year, and they munched it all into this. Because if you pull those jobs from that reading, unemployment went up, right? Which we know, because all we see in the news, right, is people getting laid off, people getting laid off, people getting laid off. And that's why I think March 10th, in a couple of days, we're going to get a very, very favorable report in terms of unemployment that is going to tell us that people are indeed filing unemployment and filing continuing claims too. And then what we're also going to see 4 days after that, March 14th, is we're going to get the new reading for inflation, which is the CPI, Consumer Price Index. And I guarantee you that's going to come in very favorable as well, showing that people are spending less money. If people are laid off, they don't have the bread. Therefore, they're not spending the bread. So they're not spending as much money. I think those should really hopefully show us where the market transitions. And then the biggest date is May 10th. May 10th is going to be where we should circle on our calendars. That's going to be a date that is going to really tell us where the Federal Reserve is going to shift in terms of their mindset. We're going to see where they're going to talk about in terms of their minutes. It's going to be kind of right into the heat of the spring market into the summer market. And I think from there on, will give us a firm understanding as we start gearing into the middle of 2023, how the market's going to transition. So.
Right. And so the market's always going to have its ups and downs, like you mentioned before. But, I know that for a lot of buyers, it seems like a dark, ominous room. And it's like scary and overwhelming. And people are talking in your ear. People that probably never bought a piece of land or real estate are like commenting and opinionating in your ear. And you're missing out. And that's bottom line. Because as crazy as it is, like I literally was just talking to a client that were preparing a listing. I sold her a house about 7 years ago. She purchased it for $445, brand new 3-family in the city of Newark, and now we're listing it between $850 and $875. So in 7 years, she literally doubled her money. And you know what she put down? Like $15,000 because she did FHA. So $15,000, which she recouped in no time from the rentals that she got from the property. They've been paying her down, her mortgage down all this time. And now she doubled her money in 7 years. So listen, I know people are making money in crypto. I know people are making money in the stock market, but there's no safer investment than real estate where you can definitely be banking on a return. It may fluctuate here and there, but it's always going to go up. My mom bought a 3-family for $40,000. It's worth almost $800,000. So like, dude, it's mind-blowing how you can create wealth. So we're here to be your light in that room to guide you and educate you. And I don't care if the rates get up to 15%. If you're buying a home, like an investment home, and you're crunching the numbers and you're calculating that 10% interest rate, but then you're also accounting for the income that it's generating. At the end of the line, if that profit is there after you paid the mortgage, you paid your taxes, you paid your insurance, you collected all the rents, and you have that bottom line profit, why would you not invest your money and then just refinance as soon as the rates dip? Because they are going to dip. It's not like they're going to keep going up to 100%. So take advantage of having your money work for you, put it into an asset, regardless of what the interest rate is. As long as it's making you money, it does not matter what it's costing you to borrow to make that money. Because that's what you're doing. You're paying to borrow money to make money, bottom line. So if you're not coming in cash, you're borrowing that money, you're paying a premium to borrow the bank's money, but you're going to be making money with that investment. You're golden, because now you're making money on a month-to-month basis. You're appreciating in equity every single year. So you can then later on do a line of credit or a refi, pull cash out, and then dump it into more investments. So now you're doubling your profits. And this is how real estate investors become millionaires and retire and literally live off of their investments. It's a very simple formula. It seems overwhelming and so scary, but if you have the right team by your side and educating you and crunching numbers and verifying the numbers, and I always run very conservative numbers. All my clients can tell you, like if the rent capability is, let's say, $2,400 per apartment, I'm calculating between $2,000 and $2,200 because I want a little cushion. I rather impress than disappoint. So we always cushion the numbers a little bit to just make sure that the numbers work and that there's still a profit even by lowballing everything. So that's really critical for buyers and investors to understand. You guys can wait by the sidelines, but what if the market just keeps going up? And instead of you buying that investment property for $700,000, you're going to be paying $850, because the longer we wait, the more everything keeps going up. And there's not going to be a deflation period where everything's going to come crashing down like the 07 and 08 market that we experienced. We're not having turbulent times because of bad loans. We're having turbulent times because of inflation in the economy. So that's what people need to educate themselves with, and listening to the CPI reports and being familiarized to what affects the interest rates, which then affects the real estate prices and the market. And if you talk to people and you educate yourselves, it seems less scary because you're informed. Fear comes from lack of knowledge. So as soon as you start to educate yourself, you're going to feel more comfortable, and you're going to break the seal and jump into the investment pool and start changing your life. Because Once you have those real estate investments producing money on a month-to-month basis for you, guess what? Maybe you don't have to work those overtime hours and you could start a side hustle. There's so many options when it comes to real estate. And I want you to elaborate as far as like some of the things that, or the tools that you have within your bank that can, I guess, assist the investors to better manage their investments or like get as much as they can.
Yeah. So we work with a lot of different institutions in terms of, I guess, again, the first thing, the most common one, right? If you're an investor, right, it's analyzing your individual situation. So if you're an investor who you own your own business, and then my first question is, well, how do you file your taxes, right? And then most of them, it's, well, you know, I'm a sole proprietor, so I file a Schedule C profit and loss, and I write everything off. And then I'm like, okay, so you're not going through my traditional bank, right? So we have to start getting creative in terms of an investment bank. So I'm like, okay, so what's your goal? You know, I own a home already and I want to buy an investment property. Okay, cool. So there's generally two main programs that we're going to look into. So do you make a lot of money? Yeah, you know, I get money that comes in my bank accounts and this and that. So then I start thinking, okay, bank statement loan. Send me over your bank statements. We'll take a look at the 12 months like we've done for some of our clients. As long as there's deposits that are being made comparative to the withdrawals, you qualify. Very simple. The other aspect of it, which you get all these goons on social media that talk about and have no idea what they're talking about, is the DSCR loan, the debt service coverage ratio loan, right? So that one has to be, in the majority of the time, owner occupied. I'm sorry, investment property, right. Vice versa. Has to be an investment property. And it makes sense, right? Because you're using the rentals to cover the mortgage. And that's how it is. And that's essentially a no-doc loan. Your credit score needs to be there in order to get the best possible interest rate, right? Because it is essentially a high risk to a bank. But remember, a lot of these type of programs too, you know, the down payment requirements are a little bit higher because they are essentially driven collateral based, right? So you're putting a little bit more money down. But as an investor, like we spoke, right? What's the three main things? What's your monthly? What's your cash to close? And what's your ROI, right?
Right.
How much are you going to be making cash flow at the end of the month? And if it makes sense, which has to make sense, right? Then we're good to go, right? And those are usually the things that we look at. There's other alternatives with the many different institutions that we work through as to if you're an ITIN borrower, if the condo, I just received a call today from an agent. He goes, hey, I'm under contract right now. We're about, so fucked up. We're like 2 months in, but we're running into an issue, you know, with the condo association. So I'm like, all right, shoot me over the condo questionnaire. I'm driving, coming back from Princeton. I looked at the condo questionnaire. One of the things that you look at is percentage of ownership. So within institutions, in Fannie Mae for a regular mortgage, which Fannie Mae is what all banks follow rules through as a secondary government, they have about one owner has over 30% ownership, and it's more than 20 units. Done. You can't get regular financing. For 2 months, they've been stringing it along with the other institution who's working it, and I'm like, dude, this gets no financing. You can get non-traditional financing through an investment type of bank, right? Portfolio bank, but you're not going to be able to get a regular conventional mortgage. So I think it's just assessing that, but going back to it, right? You're a very reputable agent. You've been doing this for a long time. You're going to know when you're going into a condo, whether you're listing it or whether you're buying it, you're going to know what to look for, right? You're going to look at the delinquencies. You're going to look at the reserves. You're going to look if there's any lawsuits against them and stuff like that. And I think that's where going back to, you know, the buyers or whoever is watching this is working with the right professionals who are going to know what to look for. Because as the deal goes through, I'm looking at so much stuff. I can't even tell you what I'm looking at because it's like clockwork. Right. So it's like, all right, I'm looking at this, looking at this, looking at this, looking at this, looking at this checklist. I'm like, you're good. We're in the clear. We're closing. And I think that falls back to that, right? Because, you know, this business is definitely not a get rich scheme, right? Like a lot of some professionals. Remember, I also run a school, a licensing school. So I'm seeing a lot of people who are trying to get into it less people last year. Now it's starting to gear up more, but it's understanding that working with the right professional, not your cousin who just got their license and you simultaneously want to give them the business. All good. You know, you're going to see them at the barbecue party, turn them a blind eye, right?
Right.
But I think that really falls back into it, man, because when I see some clients and some of the situations that they're in and they're deep into it, right? And they're going to lose their EMD, they're going to lose their deposit, or they've already spent money on their appraisal and inspection. I take a look at it and I'm like, dude, I can't even help you, you know, because you should have never been pre-approved from the start. So
I think it also falls on the realtor, unfortunately, you know, because she didn't do her homework and, you know, verifying whether or not the credentials are accurate and ready to get, you know, into a property or under contract. And I think that that's another thing that we're kind of starting to realize, especially I think like the newbie agents and like my newbies on my team, like I always teach them, like, you are not just opening and closing doors. You are providing a major service to a client that's going to be making the biggest purchase, if not, you know, ever in their whole entire lives, hopefully multiple times. But you need to educate them. You need to teach them how to get into real estate the smart way, educate them on mortgages, educate them on the law, tell them what's written in the contract that they're signing, educate them on easements or whatever the situation that you encounter, underground oil tanks. So like that, you're the trusted professional. Like they don't need you to open and close a door. They need you to guide them and educate them so they know that they're making the right purchase for their family or for them and their investment. So educating your clients and being a knowledgeable realtor is so imperative. Anybody that's thinking about buying a home or thinking about maybe buying a second home as an investment or whatever the case is, interview agents and interview loan officers, just like you would to hire any other service. Like when you want to redo your kitchen, do you call one contractor or do you call two or three? Yep. Most of you call multiple contractors because you want to get the best price. But you also want someone that's going to be experienced and not have you invest all this money into your kitchen and then it's falling apart within a year or two. So the same thing goes with your realtor. I know we're a dime a dozen these days, but you really need to interview and get a vibe for the person. Like you may think that someone's knowledgeable, but you don't like their energy or you don't like who they are as a person. That's cool too. That's a reason to disqualify. You kind of have to like get to know them and see if this is the person you entrust putting your money into, because that's who's ultimately going to be negotiating on your behalf and running the transaction for you. So you want an agent that's going to be able to answer your questions and know exactly what you're talking about and not just basically show properties. So I think that
it falls back to that. I you know, a lot of the times I tell the clients, it's funny you said it, right? Realtors are a dime a dozen. I've run into the same ones because there's a billion of them, but there's only like a few of us that are actually working. But I
know what we're doing.
Yeah, I think it's definitely being vetted, right? Vetting a client, you know, education is just so important. That's a God's honest truth. Because products wise, guys, I say this all the time and people look at me like I have 10 heads. Banks offer the same stuff.
Right.
FHA loan, everybody follows HUD guidelines. Conventional loans, everybody follows Fannie Mae guidelines from a minimum. Some banks have additional, like some banks won't do 650 and below, right? I've literally done a 576. Even when we got the exception from my corporate, I'm like, really? So I think it's getting understood, making sure you're getting an education standpoint, especially right now. Because if you turn on the news, you think, you know, you think the world's burning outside and everything is a little bit more expensive. But you know, making sure you have a firm understanding of what you're looking for. The clients who I told you, the 476, I'm sorry, 470, then it ended up going to 483. They were looking at multifamily homes. We're at 550. Which basically everybody else who's looking for a multifamily home is at. Right. We just kept losing. You know, we kept losing. And then I told them, hey, why don't we shift our focus to a single with a basement plus, right? And then this one was perfect, low taxes, right? Ended up working out, found it, got it. 3 different borrowers, which are never fun, but each person liked it. We were good. And then it was the price point was the scary part, because remember, now there's no more rental assistance because it was a 2-family.
Right.
But eventually we did some shifting. Everything worked out in our favor. God blessed us with this 10K overage, right? Now I can do a concession. Boom. And it's funny because when I literally got the appraisal, instantly I was like, seller's concession, right?
Yeah.
And then I was like, do I use the seller's concession towards paying the closing costs, or do I use the seller's concession towards doing a buy down and getting the rest for the closing costs of what's remaining? Now, I don't make the decision for the client. It's Mr. Client, right. Option 1, you save $600, but you bring $25,000 to closing. Option 2, you pay $600, but you only bring $16,000 to closing because it's 3.5 of 483. What is better for you? Are you, I'll bring it back to what I said first. Are you monthly payment conscious, or are you cash to close conscious?
Right.
And she's like, no, I'd rather get the lower payment. Perfect. So we're going to go option 1. Mrs. Attorney, can you kindly draft an addendum? I'm not going to tell you. I've actually learned that probably the nicer way, where I'm like, don't just do everything.
Yeah.
And then I'm like, hey, can you please kindly draft an addendum and just basically do this, or that? Call the buyer's agent, call the listing agent, call the seller's attorney, hey, heads up, buyer's attorney is going to shoot this over. I'll let the buyer's attorney kind of dictate what the terms are, but I'm just giving you a heads up. This is a strategy of what we're thinking about. I can't divulge too much information in terms of the strategy, but these are some of the things that we're working through that I think the clients are going to be happy with wanting to proceed.
Right.
But it falls back.
Boom. And that's what clients need. They need you, a person like you, to come in and say, these are your options because of the result of this. You're going to educate them and let them have the preference as to whether they want to bring more money to closing or pay lower on a monthly. Yeah, exactly. So the same is with the realtor, where it's like, we look at a property and we're like, if you did this, we can raise the rent to that. If you incorporate that, like even as simple as like a multifamily, and just advising them, hey, why don't you just put some coin operated washer and dryers down here and make enough money to cover the water expense for the property. Like just simple things. It's an educated realtor, it's an educated loan officer that really just take your investment or your process of purchasing a home to such a different level. It's so crazy, because like I encounter clients that have purchased with other people in the past or have worked with other loan officers in the past, and the horror stories that I hear, it's like, shit, if that happened to me, I probably never would want to buy another home either. You know what I mean? Because it's just like really messed up situations, or like a pity to see that they could have maximized a little bit more on their investment and get a better return, but yet they weren't informed because no one ever told them.
Totally agree. There's right now, I could tell you the common approach, unfortunately, with some colleagues, I guess I'll call them, some other lenders, is the bait and switch tactic, right?
Oh my God. I don't even know how that's even still allowed.
I get a lot of phone calls, from Google, right? And people are reaching out, and I'm like, hey, what's going on? They're like, hey, yeah, I see your reviews and you can close really quickly and this and that. I'm like, yeah, what do you got? So I have this, the lender quoted me 4.5%. And then I'm like, for a 15 year?
How long ago?
Like, no, my first thing is like, for a 15-year? He goes, right. Yeah. And I'm like, okay. I'm like, what'd you get? He's like, he goes, I'm supposed to close on Monday. This phone call came in on Tuesday. Like, it's supposed to close the following Monday.
Right.
He called me the Tuesday before, basically. He goes, yeah, I just locked at 6.5. And I'm like, yeah, 6.5 right now is realistic, to be completely honest with you, based on what you're telling me with the parameters. And there's a reason why the loan officer held off 4 days before closing, is because the loan officer locks it, and then he sends your CD the next day, and you can close 3 business days after that,
right?
Which is Wednesday, Thursday, Friday. You can close Monday. And then I'm like, if you want, I can help you. I can't close in 3 days, not because I literally can't, because legally I have to wait 7 days per the TRID rule. I'm like, so if you want, I can close you guaranteed by next Wednesday. I'm like, but I cannot close you on Monday because I just can't. It's federally not allowed. hung up, never heard back from her. So he obviously, and he was a little worried. He's like, no, I have to close on Monday.
He probably was served with time of the essence.
Who knows? But you know, so you want to be careful. So if you're a buyer who's out there and you know, you're being promised one thing, especially from an interest rates perspective, Car, you see what I do. I just show the client, hey, look, these are your interest rates. You know, it's not me. If you get it, I'm a regular direct lender. If you get a 2%,
it's not me, it's you.
If you get a 2% interest rate, but for the truth is, it is you with your credit score and your
yeah, exactly, on your credentials.
But if you get a 2% rate or a 10% rate, it literally makes no difference to me from a financial incentive. And I know you've heard me say that before all the time, right? Client, if you have a 2% interest rate or a 6% interest rate, I still make the same amount. I still make from X perspective. So I want to put the best possible deal together, and I want to educate you as to maybe why you shouldn't pay $5,000 of discount points, because you're only saving $100 a month. And if you're only saving $100 a month, that is going to take you basically almost 4 years to recoup the benefit of you putting $100 a month. I mean, you putting $5,000 up front and only saving $100. It's not worth it. You're going to refinance the loan before 4 years. I highly recommend that you just take 7% instead of 6.75. 6.75 sounds better than 7%, right? To our ears. But if I put the numbers in front of you and you're only saving $100 a month, but you have to pay $5,000, I would say don't do it. Take the 7, stick, and then move on forward. So.
Yeah, and honestly, guys, we've almost been on for an hour, so I'm gonna leave like one more tidbit of information. We'll definitely be doing another live. We definitely want you guys to get involved and ask questions so we can address your concerns and issues, or maybe experiences that you're currently encountering, and see if we can shed some light and assist you in that. So feel free to, you know, post any questions you may have in the remaining time that we're going to be on. But I also wanted to educate them on, I think that what a lot of people don't understand is the whole, what does the CPI have to do with interest rates? What does unemployment have to do with interest rates? And I want you to elaborate on that, because I think what people need to understand is the root of it. So like that, they get a little better understanding of how one thing triggers the other. It's like a domino effect. So if the CPI report shows the inflation numbers are high and unemployment is low, boom, the interest rates are going to go up, because the government is trying to control inflation, where it doesn't get to a point where homes or anything become unaffordable to most Americans. So for instance, if they did not start raising the interest rates due to the inflation numbers, we would probably be paying $1 million for the houses that are currently on the market for like $700,000 or $800,000. That is how it's been happening. Like on average, the homes increased 43% over the last 2 years. 43%. So whoever bought a house within these last 2 years, you lucky ducklings, that especially the ones that locked in at the low rates, your property increased on average about 43%. Where could you invest your money and get 43% return?
Yeah.
I mean, you have to be like Wolf of Wall Street, like to know exactly what stocks to pick and when to sell and buy. So elaborate for us so we understand, and we're educated buyers, what those numbers are and how they do affect your interest rates.
So I mentioned it earlier. So unemployment, when people are losing their job, right? That's a scary thing, right? For the Fed, because they're like, oh snap, people are losing their job. What they literally said was people are spending too much money because CPI measures inflation. So what do? They make the cost of stuff more expensive for manufacturers, which is a whole different
eggs
called PCE report. Exactly. Dude, eggs is like,
eggs.
I never knew.
This is why eggs is so expensive. It's not a lack of chicken, people.
Yeah.
It is controlled.
So they make the cost of stuff higher in an effort for people to spend less money, right? And that's basically it. Now, they literally said that they are not going to stop raising, and remember, the federal funds rate is not mortgage interest rates. The federal funds rate is the overnight borrowing interest rate for banks. It does essentially,
which is usually like car loans and stuff like that, right? It affects
exactly. So it affects short-term rates. So short-term rates.
Mm-hmm.
But right now, the reason why investors know anybody who's getting a mortgage right now is likely going to refinance into the future. So you keep an eye on that, most importantly. But I think as we start seeing a lot more people lose their job with unemployment, and when you lose your job, remember, you're not spending money. So if people are losing their jobs and they're spending less money, I think that's when the Fed is going to say, we've reached our rate hikes. We're going to stop, basically. We're going to stop hiking our rates. But like you've seen, right, people are still spending money.
Right.
So that's where the Fed is like, well, unemployment is kind of like going up, going down, going up, going down. But people were spending less money October, November, December, and January. October, November, and December, people were spending less money. And then supposedly in January, people spent more money. I think it's all kind of fictitious reports, but who knows? You know, maybe
I
the
don't
holidays.
know. Maybe a lot of people got Christmas money.
Yeah. So that's that. So we're going to look at unemployment. People losing their jobs is not a good thing, right? Fed will maybe slow down, but they did say specifically that we don't care if a lot of people lose their job. We need a lot more people lose their job, right? And then they're going to monitor the spending. If people spend less money, then if they're spending less money, then that means they've reached the point where they're not going to hike it anymore, right? And then we kind of think
you're going to start seeing the prices drop as well, of like eggs and groceries in general and gas and all that fun stuff.
Yeah, I don't think home price. So one question I get all the time is, will home prices drop? So home prices is sometimes geared towards rates, but remember, you mentioned it before, right? It's a supply and demand. And back in the market crash, we have an oversupply of homes and some really crappy loans that were being done, right? Right now, it is, I mean, it's hard to get a mortgage, right? I mean, we're doing them super, super fast because we know what to look for, but it is sometimes difficult to get a mortgage, even if you can qualify for a mortgage, right? So the guidelines are tight, restrictions are tight. There are certain things that are being done, though, from the Joe Biden administration now to help homeowners. Like they've reduced the FHA mortgage insurance premium. I think it was either earlier this week or late last week. They reduced it,
last week.
Which basically means now that mortgage insurance for FHA buyers is going to be cheaper, right?
Right. Lower payments, guys.
I'm already noticing it right now within when I'm building transactions, and I'm like, oh snap, it's only $115, when normally I would see it at 200, 225 for some consumers. And remember, as home prices go up, your payments are going to go up. So I think that was a good thing that they did in regards to dropping it to 55 basis points as opposed to 85. And just kind of keeping a lot of eye on that stuff and keeping us educated, I think is super, super important.
Right. And I think that I agree with you in reference to the home prices. I mean, I weathered the 07 and 08 storm, and I was a big producer for Countrywide Mortgages because they were offering the 100% financing. So, you know, what better deal? You're literally buying an asset, a money-making asset, and not putting any money down. At most, they were putting like their $5,000 escrow deposit and using that as part of their closing costs because the seller's concession that they were also mortgaging kind of exceeded that. So when all those bad loans were written out, literally it was to people that did not qualify, did not have sufficient income. And some of them did qualify, but unfortunately what they did was they used their home equity as an ATM machine. And I know because I had plenty of investors that literally were constantly refinancing and taking equity out till they were completely tapped out. So they originally bought, let's say, for $400,000. Then it kept going up in equity. They would take $100,000 once it hit like $500 and keep doing it over and over. And then when the market crashed and now their home was worth $350, they were like, I'm walking away from this because why should I pay $600 when it's only worth $350? I don't care if I ruin my credit for 2 years. So that was a lot of bad loans. That's not what we're experiencing now. The loan officers are still being very, very thorough with all their verification and all their paperwork and triple checking everything. So that is not going to be what you're going to experience. Over time, we will hopefully see some stabilization in the pricing. However, as far as it decreasing and crashing like it did in 07 and 08, there's no indications and no reason to lead up to that. because we're not writing bad loans and we're not overextending people. So I think that, you know, that is critical for people to know that if you're going into a property, and even though the rate may be higher, statistically, people are only staying in those homes on average 7 years. So people are like, I'm not going to be paying 7% for 30 years. You're not going to be in the home for 7 years. The likelihood of people staying in their homes 30 years nowadays is almost non-existent. It's not like the old times where people like got married, bought one house, had all their kids there, and maybe sold when they were like retired or going into a nursing home. Now people are constantly downgrading, upgrading, changing locations, whatever the case is. So you guys don't have to stress the fact that, oh my God, over the course of 30 years, I'm going to pay almost $2 million in interest. No, you're not. You're not, because you're going to pay, it's kind of like you're renting the property while it's appreciating, but it's not like an apartment. When you move out, you only get your security deposit. When you sell, you basically get the money you've paid into it, plus then some, all the profits. Yeah. So there's no better vehicle to invest your money into, because with renting, you're paying 100%. That's the interest rate on rent, 100%. You're never going to get that money back. It's literally like you shoving money into a fire and letting it burn, because that is just like to cover your living expense. But it's not a vehicle that's making you money where you can draw from and build into other things like another investment or business or whatever it is that you want to do to, you know, increase your passive income. So that's my tidbit for today. I think that we covered a lot. And if you guys are interested in us doing it again, send us some DMs, share some feedback. Oh, you know what? I did see some questions. So let me just go through the questions real quick, because it'd be kind of rude if we don't answer them. Okay, what is your best tip, advice for someone who wants to start investing? Okay, so do you want to go first, or you want me to go first?
Well, I can tell you, I'll cover, I guess, on the financing side, and then, and then you cover in terms of ROI and stuff. So when you're looking to become an investor, right, the first thing is, do you own your own property right now, right? If you don't, then generally, you know, the best model is, you've heard this before, right? You want to start with a multifamily home, put the least amount of money down, and then leverage from the bank. And then thereafter, let it sit there, sizzle. Then you can do a cash out refi, pull the equity from there, purchase your next home, right? And then also taking a look at when you are looking to invest, right? Thinking about, is it in a good school district, things along that nature, because usually you can get really good rents, right? So thinking of how is the rental market within that specific home, because when we're doing appraisals and stuff like that, we're taking a look at market rents. So we want to make sure that the rental is being covered by there, right? And then just looking at the geographic location also, right? Where are they building a tunnel around there, or a train to go straight to the city, or anything like that? Because when you do, you are going to get those New Yorkers, right? Or you're going to get some of those people who will pay top dollar in rent and don't care, because there's accessible means of transportation. So that would kind of be my recommendations of when you're looking for an investment property, what to look for. So.
Okay, thank you. And then I think that my advice, as far as like, if you don't have an investment already, just kind of have as a launching pad to get more investments, it's tax time. You're going to get tax refunds, guys. 3.5% on a $400,000 home is what? 13 and change, like 13.5, 14,000. Take those tax refunds and use them as a down payment on an FHA loan, and do not get into a one fam or condo or a townhouse. Get it into a 2 or 3 family, and let the tenants help you pay the mortgage, if not generate cash flow for you on a month-to-month basis, because you still can find deals where you could get in and the rents cover the mortgage and you live for free. Could you imagine how much money you would save from your salary if you can pocket all of that rental or expense of overhead of housing? You can utilize that tax refund to purchase a home, get in, start collecting rent, start building up that equity under your name. And then later on, as the equity appreciates or you save more money because now you're not paying as much in housing, put it towards another house. And you could refinance out of that FHA and then reuse it again to the next house that you move to. So let's say you start off with a 3 family, use your tax refund, down payment, boom, you're in. You're there for a year or so, 2 years. You want to refinance because now you want to maybe get a new construction 2-family with all the modern amenities, and they're collecting phenomenal rents because it's new with all the bells and whistles. So now you're going to rent out your apartments after you've refinanced and use your FHA again, 3.5% again on the 2-family. So this is how people are doing it. There's no like hidden secrets that is in the dark, dark web. We're here to educate you so you guys can implement these tools and do it yourselves. But make sure you collaborate with the people that are going to guide you and do it the right way. Make sure that you do it with a loan officer and a realtor that are going to educate you and show you exactly what to avoid and what to make sure to cover your ass with. And that's just, you know, me being very blunt. You have to look at how you can either get a gift from a family member or a friend, use that as a down payment. Those are allowed in order for you to make a purchase. So you literally just have to source the funds where it's coming from. So if you're getting a like gift or a loan from your friend, I need a bank statement from your friend. I need a copy of the check of him getting the money for you in your name. And then you need to deposit into your account and give your loan officer a bank statement showing that that money is now deposited into your account. It's that simple, guys.
Yep.
It's that simple. So if you guys aren't getting a huge, you know, refund, get a gift. If you guys aren't getting a gift, tap into your 401k. There's so many options into getting into investing. It only takes the first one. Once you get the first one, I promise you, all the others are going to be much, much easier.
Yep. Boom.
And there's so many options that your realtor can advise you on if you want to do it quicker, how to get to that. So that's my my last tidbit for the night. Thank you guys so much for joining us. I really appreciate all your time that you invested into this hour with us. And thank you, Abdel, for being so informative and collaborating with me. Let me just make sure everything is cleared here. And then we are signing off. All right, guys, I think that's it. Thank you guys so much. If you guys have any further questions about how to get started on buying a home, fixing your credit, loan programs, what's best for you, what's a good fit, DM us. Abdel is got mortgages here, and obviously Carlie Real Estate. We're here to help you and answer any questions and educate you on building wealth with real estate. Good night.
Thank you.
Thank you.
Bye, guys.
Good night.